Hey everyone, I want to go ahead and take a look at the SPDR ETF and the current market situation. I've been getting a lot of comments and questions on both sides of the equation. On one side, people are wondering if they can buy because the correction is over. On the other side, people are wondering if they can short the market. I wanted to make this video to kind of frame the situation for you guys and let you guys know what kind of things to look for when you want to do what you want to do, which is either be long or be short. It's very important to recognize or understand that when a trend develops in the market, it takes a long time to develop and it lasts a long time. So for example, the bull market we've been in is 5 or 6 years old. This bull market or an uptrend is 6 years old. So we are possibly the third, fourth, or fifth day of the beginning of a crash. So when you ask me, is the market done? It's really difficult to say. But we can go ahead and look back in the past and see what happens when something like this happens, because it's happened before. And when you look at this, you're going to be surprised at how similar things are and how much you can learn from it. So let's go ahead. I put in a chart on the 2008 side on the left side, and 2015 chart on the right side. As I mentioned in my previous videos, the market consolidates for about 8 to 9 months and breaks support. So here we go, just a quick review. With this first month, 1, 2, 3, 4, 5, 6, 7, 8, 9 months, and we break support. In 2015, we have something similar, 1, 2, 3, 4, 5, 6, 7, 8, 9 months, and then we break support. So that's similar, but look what else is similar. We get a big drop in price in 2008 here. We go all the way to the 125 level. But when you look at this candle, this represents an entire month, not just 1 day, 2 days, or 3 days. It's 20 something days of trading here. We see that sometime in that month, we drop to 125. But by the end of that month, we close above this support line. If we look at 2015, we drop to this level of 182, and now we're making our way back above the trend line. Does that mean once we get above the trend line that the correction is over? Well, let's look at 2008. The following month, we actually closed below the trend line. If you watch my older videos, you'll know that this was a leak, and it's a warning sign that the boat may be sinking, and it may take more time for it to develop and start sinking. But this is the warning shot that you got to know something's going to happen. So yet we can continue up the rest of the month, which is 4 or 5 more trading days here, and close above here. If we take a look at the hourly chart of the SPY currently, and I mentioned this in a post that we are currently in an uptrending channel. And if we can use this channel to project that by the closing of August 31st, 2015, we would expect the price to be within 196 and 208.84, so almost 209. So it's very possible if this channel holds, we could close at 209 or 196. Now, what could happen is we can quickly get to the top of this line and get back down here and then crawl up here to close August at 196. If we close within 196, 198, I would still see it as very bearish. If for some reason we magically closed at 208 by the end of August, wow, I would say that the market has a lot of strength. We closed above the key 204 level, and I would really have some doubts about whether we're going to crash. However, if we close around 196, 198, or 200, I would say that we probably see some more downside. If we look at 2008, we closed slightly above it, so might happen the same thing in 2015. So let's measure the range of this month's trading. So in 2008, if we measure from this month's close to the bottom of the low in 2008, it's 13.88% drop from closing to the bottom. We go ahead and compare 2015. We have a 13.34% drop. Amazing how similar the price action is. And that's why looking back in the past can be very helpful to determine how the future might unfold. So if we look at 2008 and we look at the following month, the boat was leaking here, but it definitely started sinking on the following month. And on the second month following the leak, we have a retest of this month's low. It's actually slightly higher, but I would consider that a retest. Now, for those who want to go long, you have a second opportunity here to go long. And from this particular low, you have a nice solid rally for the next 2 months. And the market rallied 15%, practically 15%, 14.37%. So you see that even as the market is starting to correct, you can have a 15% rally from this low. The market doesn't go straight up and it doesn't go straight down. It makes these ups and downs like a lightning bolt. The key thing you want to notice is if you want to go long, wait for an opportunity here to see if you can get another swing at the bottom. If you want to short, wait till you make a lower high here. This here is the high, this here is the lower high. Now, if you take a look at this low, it took 1, 2, 3, 4, 5, 6 months in this candle here for us to actually break this low and trade below that price. And it takes another 2 months for us to actually close below that low. So in total, once the market started the trend down, it took 8 months to actually continue lower. So where do you short? You short at the lower high. What makes a lower high? Well, we don't know. It could have been anywhere in this area. But one thing you could look at is the moving average. You see here, it went above the 10-month moving average, but was rejected by the end of the month. And the following month, it went back towards the 10-month moving average, and it got a nice solid rejection or a break of this candle's low. So one way to play this is short it when it goes above the 10-month moving average. Another way to play this is wait for this particular month. Once it breaks the 10-month moving average, wait for the month to close and put your shorting right here at the bottom of this candle. So you may not get the top of the short. You'll probably be very close to the top. And this is the best time to short. And this is the short that you can hold for the longest. Okay. So once you're below a moving average, you should have a bearish mind frame. So this market remains underneath the 10-month moving average until the correction is completely done. And you see here on this candle here, it finally closes above the 10-month moving average, and that's when the market can start recovering. The important part of this video is to establish the scale, the time scale that you're looking at. So to recap, the next steps I will be looking for is that we actually close below the support, probably next month. If we close below this month, that's great also. Secondly, I wouldn't really reshort until we get back into this level where there are signals For example, we could have a rejection at the 10-day month average. We can also look at the weekly time frame to find a better opportunity to short. The one candle that sticks out to me is this candle here, which is a bearish engulfing, which signals probably the end of this rally here. This bearish engulfing and this break of the moving average would be the signal to short. So that's it for my video. If you like it, please click on the like button below, or if you would like to subscribe to my channel, click on the subscribe button below the video. Thanks for watching.